Hi everybody, and welcome back to video number 3 in chapter 13. Here we're looking at solvency ratios in the sense that solvency is a longer term look at a company, determining how well or how probable they are to stay in business. So let's look at these. The debt ratio and the equity ratio. The debt ratio is the percentage that liabilities are of the total liabilities and equity. We usually use total assets to divide instead of liabilities and total equity. But as you see in this example, 73.3% of the right side of the balance sheet are liabilities. That means that only 26.7% are owned by our owners, whereas 73.3% are owned by outsiders. All right. So between the two, the debt ratio and the equity ratio, I think you can see that that has a very important position in evaluating a company's debt and equity. The debt to equity ratio is a little different than that, in that we're going to talk about dividing liabilities by total equity. So here we get a ratio here of 2.74, and that measures what portion of the company's assets are contributed by creditors. A larger debt-to-equity ratio is going to imply less opportunity to expand through debt financing. And as you would think instinctively, a bank is going to look at how much debt you have. And the more debt you have, the less likely the bank is going to give you great rates, and the less likely they may not even make you a loan. So if they think you're over borrowed, you won't get the loan at all. But if they think that ratio is too much weighted towards liabilities, they're going to sense more risk and charge you more interest to compensate for that. Times interest earned is one of the most often used ratios I have found by banks. Here, we're going to take the earnings before interest, expense, and income tax and divide that through by the interest expense. And we call that EBIT. I call it EBIT, earnings before interest and tax, divided by interest expense. And that tells you how many times we can pay back our interest with our operating income. And that's a really nice way to look at a company. The higher that ratio, the better. The banks want to have a high level of confidence that you're going to be able to pay them back. They get very, very excited about getting paid back. So we want to make them feel good about that. And this is the most common measure of the company's ability to pay its interest expense. All right, the next category of metrics is our profitability. And here we have our profit margin, return on total assets, return on equity, and the gross profit margin. Whenever you see that return on something, that almost always means net income divided by something. So let's see how well that holds up. First, we'll take a look at the gross profit margin, as I call it. The book here has called it the gross margin ratio. And basically, that's our gross profit divided by net sales. What is gross profit? Net sales minus cost of goods sold. So gross profit divided by net sales, in this case, is 37.8%. This measures for every dollar that we sell, this is how much we get to keep after paying the cost of that sale. So in this case, 37.8%. Now in the case of profit margin, whenever it becomes unmodified, like it is here, it doesn't say gross profit margin or operating profit margin. This is profit margin. That means it's going to be net income divided by net sales. So here, that profit margin is 21.2%. That's a really good profit margin. That means that for every dollar of net sales that we make, we get to hold on to 21.2 cents of that. And that's a very important measure, as most companies view profits as an extremely important metric. All right, return on total assets, and here we're going to divide by average total assets into net income. Return, again, normally means net income divided by something. In this case, it's total assets, precisely average total assets. So here you can see we take our net income and divide it by our average total assets. And that measures how well the assets are utilized by the company. The relation between profit margin and total asset turnover and return on total assets, as we described in one of the reflections, is shown here. Here's our profit margin, our total asset turnover, and return on total assets. So here, profit margin, here is our total asset turnover. So you can see that this net sales here washes out when we multiply it through to get return on total assets. Okay, return on equity. Here we're going to divide net income by total equity. And in this case, it's 55.9%. And what that measures is the company's ability to earn income for its common stockholders. Common stockholders are our owners. This does not include preferred stock owners or that kind of thing. This is purely an indicator of the ability to earn income for our owners, which are our common stockholders. All right, the last category is market prospects. And here we use these ratios and yields quite frequently in evaluating portfolios, even in our 401k or other work that we do both personally and for the company. So here the price earnings ratio is going to be the market price divided by the earnings per share. And as I mentioned, the earnings per share is the net income less preferred stock dividends divided by outstanding shares. Okay? And then once you have the earnings per share, which in this case is $11.97, we divide that into the market price. Now this is one of the more difficult ratios to truly understand, because here this has come out 24.5. What does that mean? Well, I would just tell you that the average multiple, as I call it, price earnings ratio, is maybe 13, 14, 15, 16, something like that. So what does that tell you? That tells you that this particular company, the expectations for the future of this company are better than average. That means its market price is selling a little bit above what you would think would be average. And that would mean that the people, the investors in this stock is thinking, my market expectations are looking really good. It takes a little practice to really evaluate this, and I think in some ways the best way to do this is to look at similar companies in the same industry, or compare that to some of your investment choices. All right, dividend yield. This is a pretty easy one. Here, we're going to take the annual, emphasize annual, cash dividends per share. Now, let's say that that's 75 cents a quarter. In that case, it would be $3 annual dividends. Okay, then we divide that by the market price per share, and that tells you if I invest in this stock and I pay $293.65 for that, I'm going to get 1% return just from dividends. And of course, we all want our stock to go up in value as well. So this is just one piece of why you might want to invest in this company. All right. All right. In this case, Exhibit 13.16. You are welcome to use this for the exam. I don't ask that you memorize all these ratios. Even for me, sometimes they're slightly different in the business world. The banks have slightly different calculation methodologies, etc. So for this book, I allow you to use this in addition to your notes for taking our exam. It's Exhibit 13.16. All right, so now, we're going to summarize and report the results of the analysis. And here is our executive summary, an analysis overview, evidential matter, assumptions, key factors, and inferences. And in Appendix 13 Alpha, we explain the form and assess the content of a complete income statement. And a complete income statement, we want to isolate that income which is sustainable, meaning it's going to continue into the future. Okay, so we can have changes in accounting principles. We might discontinue a segment, and we can look at all of these and determine what is sustainable income and what we think that that's going to mean for the future. Okay, so an all-inclusive income statement here is going to include net sales. Then below that, they've got the operating expenses, and part of that's cost of goods sold, and it comes out to income from continuing operations here. And then we have a discontinued segment, and then below that gives us our net income. And then below that, we have our income from continuing operations, discontinued operations, and then finally our basic earnings per share for what we expect will continue on these 200,000 shares of common stock. Outstanding. All right. Well, that concludes Chapter 13. I think you're going to really enjoy going through this chapter in a little more depth. That's why your future and current employers want an MBA. They want people that can analyze things. And as you go through this chapter, I think you're going to learn some nice techniques, but you're also going to learn how to analyze maybe a little better as well. So when we return, we'll move on to the next chapter. Until that time, bye for now.